In 2025, crude oil fell over 20% to post its deepest annual loss since 2020 on surplus concerns. A punishing supply is expected to weigh on prices this year as well. However, fuel prices at Indian pumps have remained elevated since the government cut petrol and diesel prices in March 2024. In this next report, we dive into why fuel prices haven't come down in the country, despite a significant fall in international crude. Take a look.
Benchmark oil prices marked their biggest annual slump since the pandemic in 2025, with a significant loss of more than 20%. As a result, US fuel at the pump is less than $3 per gallon for the first time since 2021. However, Indian consumers have not seen the pass-through. While regular adjustments have been made to jet fuel and commercial LPG costs, the last time fuel prices were lowered in India was in March 2024. Back then, the government cut petrol and diesel prices by 2 rupees per litre. Since then, in New Delhi, petrol prices have remained at 94.77 rupees per litre and diesel at 87.67 rupees. The prices at Indian pumps have not changed despite over 20% decline in Brent and US crude last year. Let's look at the key reasons for the disparity in why Indian consumers have not seen a proportionate benefit from the decline in global crude prices. A large chunk, around 50 to 60% of the final retail price, goes towards taxes. The central and state taxes act as a barrier for the pass-through to the domestic market. The government manages to use the excess to control budget deficits, finance social programs, or compensate for losses sustained during periods of high crude prices. This prevents the benefit of lower crude prices from being passed on to the end consumer. In most developed countries, prices are revised on a daily basis. Although fuel pricing is officially deregulated, state-owned oil companies do not revise retail prices often. This allows them to manage their own margins and recover previous losses during periods of high crude prices, rather than providing immediate relief to consumers. The dramatic fall in the Indian rupee to record lows in 2025 has not helped the scenario. Crude oil is purchased in US dollars. A weakening Indian rupee against the dollar can offset some of the gains from lower global oil prices. The reason, Indian importers have to pay more rupees for the same amount of oil. India broadly uses a revenue management system to deal with the fluctuation in oil markets. The government tries to limit any significant hike in fuel prices when crude prices rise internationally. That is mainly to avoid a backlash from price-sensitive citizens. In essence, the government and state-run oil firms use the cushion provided by lower international prices to improve the nation's fiscal health and their balance sheets. Business Bureau, WION World is One.